All right, well, stocks continue to flirt with record levels, but investors are grappling with the Federal Reserve's looming rate hike in the background. Low rates have kept stocks elevated. So when the Fed does hike rates, what does that mean for stocks? Let's bring in Scott Wren, Senior Global Equity Strategist at Wells Fargo Investment Institute, for more analysis. And Scott, you said in a recent note to clients that the last thing you want to see is the Fed raise rates. Does that mean you're expecting a huge sell-off when the Fed does pull the trigger?
Well, Scott, I think for me, it's the pace that they raise rates. If they come in, and I think September would be the earliest time that they would do it, and they steadily raise rates, I think that's the wrong thing to do in the economy that we have right now. If they did steadily and consistently raise rates, let's say at every meeting after September or whenever they start, I think the market would have a little trouble digesting that, especially if the Fed doesn't prep the market well ahead of time. You know, we talked about, Janet Yellen talked about last week, you know, June. There's some analysts out there that still think a June rate hike is on the table, which for me, you know, the Fed has not nearly prepared the market, and if they would hike rates in June, that would cause a lot of volatility, probably downside volatility. So I'm a firm believer that well in advance, 3 months in advance, 4 months in advance, the Fed is going to virtually tell us, maybe in Fed speak, when they're going to make that first rate hike and what the process, what the pace is going to be after that. And so I think if they do something in September, it's going to be a token increase just to get the ball rolling. But to be honest with you, I don't really think they would need to do anything this year to raise rates.
So after the first rate hike, would you want them to do something like every other meeting, perhaps? Is that a better pace?
I think once they get the ball rolling, I think you could even see more than a meeting between hikes. So a meeting, 2 meetings, something like that, because the Fed, of course, keep telling us that they are data dependent, and I think it's going to be data that's very choppy, certainly on a month-to-month basis. So I really do not want to see the Fed just to start to steadily raise rates. I don't think the economy's ready for that, and I certainly don't think the stock market's ready for that.
Well, yes, the Fed has indicated many times in the past that it is data dependent, but you say the data points they're looking at are lagging indicators. So does that sort of guarantee that when the Fed does raise rates, it will be the wrong time?
Well, usually if you look historically, and in the note that I wrote that you referenced, you know, it's frustrated me a lot over the years that the Fed keeps telling us they're data dependent, because of course by the time the data comes out, typically the market's moved in advance of that. I'd like to think that they could anticipate and have some good analysts at the Fed that would be able to project pretty accurately. But if you look at the history of the Fed, certainly over the last 30 plus years that I've been in it, they're wrong a lot, whether it's GDP, whether it's inflation. You know, the Fed makes a lot of wrong projections. And so if they acted ahead of time on a lot of their projections, and if they would have raised rates when they thought the economy was going to move higher, let's say, or move at a faster pace, whether it was 2014 or coming into 2015, you know, the economy was not ready for that, and I certainly don't think we'd be setting record highs in the S&P 500.
All right, so for investors, what's the bottom line? What should they know amid a rising rate environment in terms of sectors to look at, and maybe even companies that you like that might benefit from higher rates?
What we've been telling our clients is that you want to stick to the sectors that are sensitive to a continuation of this recovery here and abroad. We like the consumer discretionary sector, we like the industrial sector, we like technology. The Fed is going to go at a very, very slow pace. I think that this cyclical bull market still has a couple more years to run. I think through 2017 we only have a very low probability, less than 20% of a recession, and I think we're going to see 6 to 10% total returns 15, 16, and 2017. So we want our clients in this market. We want them buying on pullbacks. Volatility, as we keep telling them, is your friend, not your enemy.
All right, Scott Wren, we have to leave it there. Thanks very much for joining us.
All right, thanks, Scott.
I'm Scott Gamm, and you're watching The Street.